Welcome to Financing Your Business to Supercharge Growth. This session is presented by PNC and Baker Donaldson. Let's meet the panelists. First, Wayne Ackland, CFO, TriStar Energy. Next, meet Tanya Mitchum-Grindon, shareholder, Baker Donaldson. Welcome, Alfred Lumsdaine, Executive Vice President and CFO, Quorum Health. And your moderator is Mike Johnson, Regional President, PNC Bank. Mike, the virtual stage is yours.
All right, so hello and welcome. I'm Mike Johnson, President and Head of Corporate Banking for PNC Tennessee, and I'm really excited about today's discussion. Perhaps a good way to kick things off would be to provide a bit of background and context of our individual experiences with capital raising. Personally, I've spent my entire career over the past 23 years working with commercial, middle market, and large corporate businesses as a financial advisor, helping those companies find the best capital structure to meet their strategic goals. Of late, as we progress through the pandemic, we've seen the commercial debt markets have returned to ultra-competitive spreads and structures as more lenders are chasing fewer opportunities. But that's from the banking perspective, and would love to hear the perspective of the rest of the group. So, Tanya, you want to kick us off?
Hi, my name is Tanya Mitchum-Grindon, and I am a corporate finance capital markets lawyer at Baker Donaldson. And I run the business department here at Baker. I have been practicing for almost 25 years, doing capital markets, taking companies public, doing follow-on capital raises. I also do mergers and acquisitions and general corporate governance. Over the last year with the pandemic has been very interesting from a lawyer's perspective. Early on in the process, about a year ago, my clients were much more in a defensive posture of how to preserve capital. It was really a how are we going to survive this mentality? You know, a year ago, I had situations where we were right in the middle of the issuer tender offer for a public company client, and we nipped that in the bud and stopped it. And it was about loans, trying to pull in as much capital through debt as possible. And I've noticed over the last 3 to 4 months, it's really pivoted to more of an offensive posture now. And like I have one client that's on a 3-track process that was looking to do a SPAC versus strategic acquisition versus IPO. And then we are taking them public this week. I have other clients that are like, okay, we've weathered the storm. Let's stop being defensive. Let's really pivot and move to how we can be offensive. So, and it's in a very different mindset than it was a year ago. And it's very exciting now because clients wanting to do a lot of activity in terms of raising money and how they can do it.
Interesting. Thanks, Tanya. Wayne?
Hey, thanks, Mike. I'm Wayne Ackland. I'm the Chief Financial Officer at TriStar Energy here in Nashville. I've been with the company about a year. Been doing this about 30 years. Started my career at KPMG. I was a partner at KPMG on the audit side, and worked a lot with companies that were high growth companies over the years that raised a lot of money, made a lot of acquisitions. And then about 10 years ago, I transitioned into the private accounting side, started over at Gibson Guitar as their CFO, and have been several places since. Primarily working with companies that have made quite a few acquisitions over the years, high growth and with pretty high expectations on the outcomes for the owners. This past year, we've made an acquisition, the largest acquisition in the history of TriStar Energy. We made an acquisition that increased the size of our company by about 50%, right in the midst of the pandemic, right in the midst of all the changes going on in the capital markets. And we'll talk about it in a little bit later. Some of the key things that I saw just differing changes is really just having a bank group that really supports you, knows what your plans are, knows what your goals are, and really believes in you and your vision. And I think, I walked into a great situation at TriStar where the company had delivered for many years for its bankers and for its owners. And so even in the midst of a pandemic, the banks were willing to make that lend to us to allow us to have the capital to make that acquisition. So it's definitely a different environment these days, and it's constantly changing every day.
Thanks, Wayne. I'm sure it was quite a task during to close on that transaction during the pandemic. So good for you guys and getting through that. All right, thanks, Wayne. Alfred?
I'm Alfred Limstain, CFO of Quorum Health Corporation. I joined Quorum in 2018. Prior to Quorum, I spent approximately 15 years at another Nashville healthcare company called Healthways. Healthways was a very different capital raising background and experience where our primary focus was supporting a very fast organic growth, 30 to 40%, focused on supporting both organic growth for a number of years and then pivoting to more of an M&A orientation. Coming to Quorum was a very different set of circumstances. Again, in 2018, it's an organization joined eyes wide open in terms of the need for capital restructuring and a reset of the balance sheet that would position and support the organization in a sustainable way. And I reflecting on Tanya's comments, now that Quorum has gone through that 2020 restructuring, we're pivoting from a real defensive posture to an offensive posture where we're positioning the company for achieving a growth strategy going forward. So really a number of different experiences. It's much more exciting to be on the growth side of it.
Super. Lots of great different perspectives here. So I'm curious, for the CFOs, Alfred and Wayne, what does your initial thought process look like when you're faced with the need to search for capital? And the second part of the question, what factors go into your decision on how you move forward?
Well, I'll start. From what I've certainly seen historically, and maybe this is no surprise, but sometimes the best set of circumstances or the best time in which to move is when the need is actually the lowest. Again, perhaps that's not a surprise, but in terms of what we're looking at, and again, I don't think any of this is rocket science, but marrying the need to the long-term strategic plan is always the optimal place to be, and in thinking through how to structure around that intermediate to longer term strategy. Of course, marrying that to what the market conditions are, because certainly there have been times we've moved quicker just simply because of the set of market circumstances that we found ourselves in at the time.
Yeah, I would agree with Alfred. I mean, as we've kind of gone through this past year, made the acquisition that we made, we had another acquisition that came upon us, an opportunity that was right on the heels of our large acquisition. And we were, at that time kind of looked at it and said, hey, is this something we really want to do? It's a great opportunity. How are we going to fund this acquisition? And that was an easy question really for our group to ask, because when we funded our larger acquisition, we really considered, in the next year or so, we may have some additional opportunities. We factored that into what we asked from our bank group and went ahead and set up a significant revolver that would allow for future acquisitions. So we just, as Alfred said, kind of planned ahead, thought through it, and have had really good conversations with our bank group on what our needs are and what they can deliver. And we kind of know their constraints, what their limits are. And if we want to dream bigger than that, we know the directions we need to go to add additional resources.
Interesting. So Wayne, closing on the large acquisition that you made, and I'm trying to go back and remember the timing of that. Had you already arranged the financing in advance of the beginning of the pandemic? And if you had, what were the responses, or did anything change within the lending environment as you guys were working your way through the process?
Yeah. Thankfully, when I joined the company in January, the company was already down the path of arranging the financing for the transaction. For us to we were competing against some much larger companies that were trying to win this bid, and so part of our deal was we had to go in with a no contingency offer for financing on day one. And so our group company had already started thinking through that and took the approach of, look, we need to restructure our credit agreement. Let's go ahead and put it in place. Instead of getting a commitment from the bank, a commitment letter that says, hey, we'll fund the acquisition, let's go ahead and amend our debt agreement prior to signing the acquisition agreement. And so we did that and put a delayed draw in for a significant amount that would allow us to do the transaction within a, say, 4-month time period. And so it really allowed us to go ahead and iron out all the details that we wanted, the economics, model that, and know that wouldn't change. And as we move forward, immediately after signing the APA, the pandemic hit, and everybody was like, "Well, where's this going to go? Is this really the direction we want to go?" Because we knew both companies. We were talking with the seller, and we both knew that we could manage the storm with our current debt positions where we sat very well throughout it. We looked at the transaction again and said, look, we're on the hook. We're committed. The bank's on the hook. They've got to lend us the money because we already had the prearranged deal with them. And so looking back, when the market significantly changed, we were thankful we had gone ahead and locked everything in and created that delayed draw. The only thing that we didn't contemplate was really from the pandemic was when we started going down the path with Hart-Scott-Rodino Act and with the FTC, that they identified two small site locations that they really had an issue with, that did not want us to own these two sites in relation to other sites that we previously owned. And so if you can imagine with the government lockdowns and everything that was going on, everybody working from home, trying to get approval through that process with the FTC was a little challenging and presented itself. And so we were faced, our drawdown, delayed draw was going to expire on June 4th. And so I dropped that date. We had to get it done. And the FTC for two small sites said, look, we're not going to let you close unless you divest of those two locations. And so that kind of set things into a little bit of a tailspin. We started talking with our lending group, and they said, look, banks are not doing deals this time. If you don't get it done by June 4th, you could have issues. And then we ended up pulling all the bank group together, having a conversation, explaining the dynamics of the deal, showing them how our company had performed during the initial phase of the pandemic, how the company that we were acquiring was performing, and said, look, guys, you need to give us a shot. Can you give us 30 days? And thankfully, because of the relationships that we had with that bank group, it was a unanimous vote. They gave us an additional 30 days, and we were able to get the transaction closed on July 6th, 2 days before the extension expired. So it was a roller coaster ride through that process. But I go back to that key point of the forethought that our legal team had of, let's go ahead and structure this deal. We don't know what'll happen. We don't know what's going to change in the next couple of months. We know we want this deal to go through, but let's go ahead and set up the delayed draw was probably the smartest thing that anybody did in the entire process.
Yeah, no doubt. And I say timing is everything, and it sounds like you guys were just hitting it perfectly going into 2020. And I remember coming through the fourth quarter of 2019, we had a number of deals in the pipeline and had a lot of momentum going. And then, similarly through the first half of the first quarter of 2020. And then with so much uncertainty going out in the financial markets, really lending was a very difficult environment. Alfred, it sounds like you all also were ahead of the curve as well, and probably arranging your restructure. If you executed in the first quarter, you were probably planning on it in the fourth quarter of 2019. How would you say it might have changed had you not had the foresight? The timing would have been different. Certainly a different lending environment. How might that have affected your restructuring?
Yeah, thanks. Great question. It was, the restructuring was a fascinating, I'll say, series of evolving events. I joined Quorum in 2018, eyes wide open relative to the capital structure and what the needs of the organization were to, ultimately restructure that capital structure. In fact, joining in 2018, in my first 60 days, we had to create relief under our credit agreement, through an amendment just to give us some relief. With regard to the 2020 debt restructuring, it was interesting from a couple timing perspectives. Certainly the pandemic playing out through that period was fascinating in one regard. The company ended 2019 functionally in default. And so obviously a lot of conversations, through that 2019 period were in place. In our case, we had many stakeholders at the table. We had note holders, term loan B holders, equity holders, and those were the folks, we'll say, at the table. There are other stakeholders, right? Vendors and employees involved in well. Given the acuteness of the circumstances Quorum was in, I would say some of the traditional options simply weren't on the table for us. But given this, I say the approach was pretty simple in terms of pursuing a path as quickly as possible that would position the company optimally for the long term. A corollary to that is, picking a path that inflicts the least, near-term damage on the company. So timing was really, I think, essential. Because this was actually a prepackaged process through court, we actually were surprised that there was a dissenting shareholder in the process, which extended our process. I guess it must have been a number of weeks, so what should have been an extremely short process actually extended out. But again, just one of those unintended consequences that you can't manage or you can't have full foresight through as you go into it. But we were extremely fortunate. We were able to close early summer of 2020. And again, it was an interesting time just with the dynamics of the impact of the pandemic on the hospital industry and I'll say the uncertainty around government stimulus that was playing out at the same time.
Yeah, I think everyone would agree the dynamics of the past year could have changed and changed the industry, capital raising in so many different ways. It's interesting. Tanya, you've had so much experience with your clients among a number of different capital raising events. I'm curious, your thoughts or your perspective on best practices that you'd recommend to your clients as they're launching their own capital raises.
Sure. Thanks, Mike. And, it's very interesting listening to Wayne and Alfred because I can piggyback on some of the things they said and that their companies did it right. I mean, the biggest thing for clients is to make sure that you're ready for prime time. Do the work before you go out and decide that we want to do a capital raise or a financing. As Alfred said, look at your midterm, your long-term, figure out what you're trying to do. In a TriStar situation with Wayne, they wanted to do an acquisition. So, get prepared ahead of time. Get your lawyers in there to make sure that you are ready for it. And again, like in the case that Wayne was talking about, getting in your revolver before you did that is exactly what the kind of things that you're supposed to do. If you're going to be a buyer, make sure you got your financing ready to go. If you're going to be a seller, get your lawyers in there, just scrub all of your diligence to make sure that there are no bad surprises once you start the financing process, or if you're doing a sell, or if you're an issuer, same thing. If it's a public offering or a PE firm coming in, you don't want any bad surprises once the process gets going. And the best way to do that is get your accountants in there to make sure your financials, there's no surprises there. Make sure your lawyers are in there to the contracts are all in good shape. There's not going to be any surprises with some, weird provision in a contract. And then also be prepared for the unknown. And it sounds like with both Wayne and Alfred, they were prepared for that because they had, like with TriStar, like you guys had the financing ready to go and you were able to go to your banks. And I was in the trenches with Alfred when we were going through all of this last year. And Alfred, just you talking about it started to give me hives just thinking about it this time last year. And and when the whole thing with the one dissenting shareholder stakeholder came about, we had worked with their mini council, and we were kind of prepared for all the contingencies that we needed to do so that you don't let one particular event derail the whole process. So it's important that you thought ahead of time, thought about the different paths that can happen when you're going down your financing, and make sure that you've got a plan for each of those contingencies that might happen, and make sure your company is ready, that there are no skeletons in the closet that you haven't examined and try to fix beforehand, because those kind of things are what will derail the process once you get going.
I'm curious, and this question really is to the group. And thank you for that, Tanya. In addition to, or aside from clearly the attorneys and the accountants that Wayne and Alfred, you guys, may rely on for counsel and for advice, are there others that you would also look to for guidance as you look to restructure, consultants, or perhaps additional bankers outside of your group to take a fresh look at things? Did any of those activities play into your plan?
They did. With our bank group, we've got 11 members in our bank group. So we've got a wealth of information, a wealth of knowledge within our own group. But we also, with this transaction, reached out to other C-level executives in Nashville and talked through it and said, look, we're about to embark on this significant milestone for the company. Sounds like we looked for these individuals that have been down a similar path, maybe not in the middle of a pandemic, but in other critical situations, and asked for their advice and their guidance. And it was really good because we were pretty confident in the direction that we were going and what we knew we needed to do. It just helped bolster our confidence and know that we were making the right decision going forward. One of the examples was right after our transaction. We had, 90 days to enter into an interest rate swap to fix our interest rate for a significant portion of our debt. That was part of our debt agreement. When we started the process, the swap rate was at, 1.25% and 125 basis points. And everybody kind of felt that was good. And as the pandemic hit, we saw it come down, and every day somebody would come in my office and say, have you locked in today? It's the lowest ever. And one of the things, when I was at KPMG, I had some clients that did a lot of interest rates, and I reached out to some of those individuals and said, what'd you do? How'd you get the right rate? And they said, look, be patient, just watch it. It's below where you ever expected it to be. Just watch it. And we finally locked in on a Tuesday at 28 basis points, and the lowest. And the next day it dropped another basis point. It made me sick that we missed the lowest by one day. But kind of the takeaway was, just be patient. But we were allowed to be patient because we had asked others their advice and sought counsel, and it really helped solidify that we were making the right decisions and heading in the right direction.
Yeah, I don't know that I've got much to add to what Wayne articulated, and of course, I wouldn't dismiss the importance of counsel from both bankers and lawyers, because having those trusted relationships I've found to be extremely invaluable. Relying on past experiences, and even if I've got a set of banking or legal relationships who aren't involved in the current transaction. Having been in the trenches with them historically, and having the relationship to bounce things off of, particularly in a set of circumstances that I personally hadn't been involved with Quorum's debt restructuring, of the nature of the restructuring, was extremely invaluable. But it's those banking and legal relationship, peers certainly. both inside and outside of Nashville, but a real depth of, obviously peer relationships and knowledge inside of the Nashville market. I've got a number of people I rely on who have seen way more than I ever will. And even the board, the relationships there, and relying on the advice and the experience of some of your board members has been extremely, not being, I'll say, afraid to pick up the phone and pick the brain of individual board members who might have seen some of the things that we're going through.
Yep, great answers. I'm just curious. So, Tanya, as you're advising, and Wayne and Alfred, as you guys are deciding on which capital providers to go with, are there what qualitative factors go into your decision making on who you're selecting and which entity or which lending credit provider that you're going with? What qualitative factors go into helping you guys make the decision? And Tanya, how do you advise your clients to think about those qualitative factors?
I think that's so interesting because expertise absolutely is important, but I think as just as important, I have found that particularly from my clients, is that you have to have a good rapport and a good relationship with the people that you're working with day in and day out. Because if you don't like your accountant or you don't like your lawyer, it's not a good personality fit. That could actually impede the deal because you have to trust one another. And you have to, you're working day in, day out, getting the financing done, getting the acquisition done. And so, sometimes someone might be like the smartest guy in the room, but it's just not necessarily a good fit on either end. So not only do you want to make sure that your providers in this situation from a quality standpoint have the expertise, but you want to make sure that they're a good fit with your company.
It's certainly, some of the qualitative factors that you mentioned, Mike, enter into it. The industry expertise is clearly critical. In my experience, knowing, being able to articulate the business. I go back to both my experiences at Quorum and Healthways, being able to tell the story, particularly in moments like a pandemic, are absolutely essential. So that industry expertise, I think is really table stakes in my view. And then, to tailgating off of Tanya's comments, I default secondly to that personal relationship. So just getting the the dynamic, the good karma between your advisors, your bankers, and the company. Just builds the momentum in every situation. I can think back to historical experiences we had at Healthways where we had a real cycle of growth, then a cycle of where we had a down market for a period of time, and being with an advisor who understands the business, who can articulate not just regurgitate the company's perspective, but also bring that broader industry perspective to identify where the industry and where the company are going, has always proven to be extremely important.
And to, follow on to that too, it's interesting with Alfred's experience, for lawyers and accountants as well, like with the restructuring of Quorum last year, I specifically remember there were 4 sets of law firms involved, and we have to coordinate with each other because it's not just one law firm, all internal. So you also want to make sure that when there are multiple constituencies involved, like multiple law firms, that they know each other, that they can work together, that they have open dialogue, and make sure that they're all, again, being at different firms, that they are all working together for the end result for the client. That's key, and that everybody understands kind of what their lane is, but with the eye towards helping the other person make sure they have all the information as well.
I would agree with both Alfred and Tanya on the relationships, just having a great relationship, making sure it's a good fit. As Alfred said, the industry experience is very important. But one of the things I would say with the previous company that I've worked for, while the financial institution that the company was tied to had great experience with that particular industry. Little did we know they really did not want to be in that industry anymore. When the company signed up with them, probably about 18 months prior to that, and really understanding where the individuals that you're relying on to provide that capital, where their views and thoughts on particular industry, whether it be the risk of that industry and the change in the risk that an industry may be facing because of change in economic situations or just change in the regulatory environments. Understanding what their position is on that particular industry, I think, is very helpful. And then also with that same situation, it was the size of our company that became an issue too. And they really just did not want to be in that size of lending to that size of the company anymore. And so having a better understanding of that could have probably provided a better situation going into it. We could have ended up with a better provider that we could have stuck with long term, as opposed to you get into a deal with somebody and then 18 months later you find yourself you need to go find another home. So it makes it a little bit more challenging when you're trying to grow a company.
I really like that point, Wayne, and it's one that I've encountered where matching the advisor to the circumstances has been really important. I personally had great success being a bigger fish, perhaps in a smaller pond at times, and then of course there have been times where I've needed the capabilities of a bulge bracket firm as well. So it's really just matching it to the circumstances has been really important.
Two really strong takeaways from this conversation or this last question. Relationships are everything, right? But really it's two parts to that. It's longevity, so that you build that trust and you have that rapport. But it's also the depth, right? So you're going beyond just the front line of the representative from the lending institution and really understanding the culture, the credit team, the credit products team, and ensuring that you have a clear vision on their perspective, both on the industry, your company in particular. And so maybe for all of those listening, those are two really good takeaways from that last question. All right, looks like we are coming up on time. Any parting thoughts that any of you would like to share with the audience on anything that we've discussed here today or anything that we haven't discussed?
I would go back to how I opened the panel discussion is, make sure as we come out of the pandemic, make sure you're ready, like go on the offensive, be thinking right now as my company comes out of this pandemic, how can I take advantage of this situation? There is so much capital, there's so much dry powder out there, people, PE firms, strategic buyers. It's starting to happen now. We're seeing it, in Q1 and going now into Q2. Just go to a different mindset of, oh my gosh, I've got to preserve my company, to like, how can I expand my company? What can I do? What are my options? There are so many options out there right now for financing. It is it's really an open book. So just make sure you're in the right mindset is my parting words.
Yeah, I totally agree, Tanya. It going back to one of my earlier comments, I found sometimes the best situation is when your need is at the lowest, and particularly as we come through the pandemic, matching, the really thinking long term and matching that, particularly given where market conditions are right now. I think it's it's probably never been a better time to be proactive.
I would agree. I think being proactive and just seizing the opportunity. When I sit here today and look back 12 months at what we were thinking, goes back to what Tanya said about being on the defense. We kind of slid into that mentality just for a very brief period of time, but pulled out of it and said, look, it's time to go on the offense. Let's get this deal done. Looking back, the growth has been tremendous. It's been it was a great decision to move forward. And not just to be afraid of situations like a pandemic that hits, but really look at it and go, let's evaluate each component. What does this really mean to us? How could it impact us? What do we need to do differently? I think that doing something differently is a big thing. Me just joining the company a year ago was that time where a new fresh set of eyes walking in and saying, look, here's all the great things that I see that you may not have seen or been taking for granted. You may have to go in a little bit of a different direction and do things a little different, but now's the time to seize the opportunity and move forward.
It's interesting. These comments really bring us full circle. I opened up by talking about the commercial credit markets having returned to ultra competitive spreads, ultra competitive structures, and it's just a reflection of your comments. There's so much capital, there's so much liquidity in the system. We've heard that, but it's really true that there are so many lenders, both traditional and non-traditional lenders, insurance companies, private equity, that are chasing these deals, and being proactive and really taking advantage of the current state of the capital markets would be really ideal. And I think our conversation now has come full circle. So if no other comments, I think this concludes our session.
Thank you.
Yeah.
Thank you.
Thanks,
Thank you.
Thanks, Lynn. Thanks, Alfred.